Hello, everyone, and a very warm welcome to Swadharama IAS Academy. I am your lead lecturer for today's session. We are about to really dive deep into what is arguably the single most important document for Indian federalism for the next 5 years. I'm talking, of course, about the report of the 16th Finance Commission. The report has been submitted, the recommendations are out, and for anyone targeting UPSC CSE 2026, this is, well, it's non-negotiable territory. Before we jump in, just a quick reminder for all of you watching, make sure to watch till the end for complete conceptual clarity, and please don't forget to like, share, and subscribe to our channel. Joining me to make sure we leave no stone unturned is our senior aspirant.
Thank you. It's great to be here. As someone who has been tracking these commissions, for the syllabus, I know just how critical this is for GS Paper 2 and Paper 3. I mean, this report essentially dictates the entire financial architecture between the center and the states. It's the playbook for how our federalism actually works in practice.
Precisely. And so often students get lost in just the numbers, the percentages. Our goal today is to really extract the logic, the why, behind those numbers. So let's start with the basics, the constitutional foundation, just to get everyone on the same page. The Finance Commission, as you know, is a constitutional body. It's set up by the President of India under Article 280, and it happens every 5 years. This one, the 16th, was chaired by the renowned economist Dr. Arvind Panagarya, and its recommendations will cover the period from April 2026 all the way to March 2031.
Sir, if I could just jump in for the benefit of the freshers watching. We're talking about Article 280 for the Union Finance Commission. But in prelims, they often try to confuse us with the State Finance Commission. That one falls under Article 243I. Right.
That is absolutely correct. A fantastic point to bring up. Article 243I mandates the governor to constitute a State Finance Commission, and their job is to review the financial health of the panchayats and municipalities. And we'll actually see later how the 16th FC has explicitly linked central grants to how well these state finance commissions are performing. It's a beautiful, real-world example of these articles interlocking. But first, let's talk about the big number vertical devolution.
Right, this is always the main headline. Vertical devolution is all about the share of taxes that the center has to pass down to the states. The 15th Finance Commission, under N.K. Singh, set this at 41%. So the big question was, did Dr. Panagarya change it?
And the answer is no, he has not. The 16th Finance Commission has recommended maintaining the vertical devolution at 41% of the divisible pool of taxes. This signals continuity, a sense of stability. The Commission clearly felt that 41% is a good balance. It gives the center enough fiscal room for national priorities, defense, highways, things like that, while making sure states have the resources for their subjects like health, police, and agriculture.
Sir, a very common doubt here, especially for those tricky prelim statements. When we say the divisible pool of taxes, does that mean everything the center collects? For instance, what about cesses and surcharges, like the road and infrastructure cess? Do the states get 41% of that?
That is a crucial distinction.
Yeah.
And it trips up a lot of students. The short answer is no. The divisible pool is made up of the net proceeds of shareable central taxes. It specifically excludes cesses and surcharges. And this has been, a huge point of contention for years. States argue that the center keeps increasing cesses because that money stays 100% with the center. But as per the current framework, the 41% does not apply to them. So while the number is 41%, the effective share of total central revenue that states get is often a bit lower.
Understood. So 41% is the size of the whole pie given to the states together. But the real fireworks usually happen over how that pie is sliced among the 28 states. This is what we call horizontal devolution.
Exactly. Horizontal devolution. That's the formula that decides the interseed distribution. Does UP get a bigger slice than Kerala? Does Maharashtra get more than Bihar? Think of it like a family allowance.
Yeah.
The center is the parent. They've set aside 41% of the income for the children, the states. But the children are all different. Some are earning well, the industrialized states. Others are still struggling. So how do you divide that allowance fairly? You need a formula.
And this is where the 16th Finance Commission has made some significant tweaks compared to the 15th. For prelims 2026, we absolutely have to know these 6 parameters and their weights by heart. Could we maybe break them down one by one?
Certainly. Let's start with the heavyweight parameter, income distance. The 16th FC has given it a weight of 42.5%. Now, if you compare that to the 15th FC, they gave it 45%. So it's been reduced just slightly.
Sir, could you just explain what income distance actually means conceptually? Why is it the biggest factor?
In simple terms, it measures how far a state's per capita GSDP is from the state with the highest per capita income. It's basically a measure of poverty or backwardness. If a state like Bihar has a very low per capita income, its distance from the top is huge. And so the formula gives it more money to help bridge that gap. This parameter is all about ensuring equity, helping poorer states catch up.
So reducing its weight from 45% to 42.5% suggests a small reduction in that equity focus, a subtle shift. Okay, what about population? This is always a controversial one. Southern states often feel they're being penalized for successfully controlling their population growth.
Well, this is where it gets very interesting. The population parameter's weight has actually been increased. The 16th FC has given it a weight of 17.5%, which is up from 15% previously. And critically, they're using the 2011 census data exclusively.
But, sir, doesn't using 2011 data still create that same issue? I mean, the southern states had already stabilized their populations by then, while many northern states were still growing?
To an extent, you're right, and that's a valid grievance. The Commission's argument is that 2011 is the most recent, reliable data we have. But to balance this out, they have the third parameter, demographic performance. This is specifically designed to reward states with lower fertility rates.
Oh, okay. And what's the weight for that one?
The weight for demographic performance is 10%, but here's the interesting part. This is a reduction from the 12.5% given by the 15th FC.
Wow. Okay. That's a vital point for the exam. Let me just recap to make sure I have this right. The population weight went up by 2.5%, but the demographic performance weight, which rewards population control, went down by 2.5%. It almost seems like a direct swap that favors states with larger populations.
Numerically, it does look that way. It seems to be a slight tilt towards the reality of where people actually live today, rather than only rewarding past policy successes. Okay, let's move on to the next two, area and forest.
Right. Area is pretty straightforward, I think. Larger states just cost more to administer.
Correct. The area parameter has been brought down to 10% from 15% before. This still accounts for the cost of providing services in vast states like Rajasthan or Madhya Pradesh. Then we have forest and ecology, which stays unchanged at 10%. This is essentially a reward for states that maintain their green cover. It's a payment for an ecological service. If a state keeps its forest, it's absorbing carbon for the whole nation, but it's losing the chance to build a factory there. This 10% is compensation for that.
I think I saw a small nuance in the report about how they define forests now.
Yes, an important detail for sure. The definition now explicitly includes open forest coverage. Previously, the focus was more on dense forests. By including open forests, they're incentivizing states to protect even less dense green areas, which are still ecologically vital.
So we have income distance at 42.5%, population at 17.5%, demographic performance at 10%, area at 10%, and forest at 10%. That adds up to 90%. The remaining 10% is a new parameter, isn't it? And I believe this is at the heart of the whole North-South political debate.
You are absolutely right. The newly introduced parameter is contribution to GDP, and it's been given a weight of 10%. This effectively replaces the old tax effort parameter, which, only had a weight of 2.5%.
So, sir, is this the big change that's driving this debate? Because logically, the industrialized states are the ones contributing the most to national GDP.
Yes. This is the pivot point of the new formula. By adding contribution to GDP, the Commission is explicitly prioritizing efficiency. States like Maharashtra, Gujarat, Karnataka, Tamil Nadu, India's growth engines, they will gain from this. They have been arguing for years, we send so much tax money to Delhi, but we get so little back. This new parameter directly addresses that grievance. It says if you help grow the pie, you deserve a slightly bigger slice.
So for Main's answer, if we're analyzing the winners and losers, the industrialized coastal states gain a bit compared to the 15th FC because of this new 10% factor. What about the hinterland states like UP and Bihar?
Well, they see a slight dip in their percentage share. This is because the weights for income distance and area which really favored them have been reduced. But, and this is a very important but, we have to be careful. While their percentage share might dip slightly in absolute terms, a state like Uttar Pradesh still gets the highest share of the money, around 17%. Why? Because their population and income distance are just so massive. No formula can ignore that scale of need. But the direction of the policy, that has shifted slightly towards rewarding economic performance.
That's a very clear way of putting it. A balance between equity and efficiency. It seems like the 16th FC is trying to walk a very fine line between the two.
That is a perfect summary. It's balancing equity, helping the poor states, with efficiency rewarding the contributors. Now let's shift to the next major pillar of the report. Grants in aid. Devolution is automatic, but grants are targeted.
The Commission recommended total grants of about 9.47 lakh crore. But I read there's a huge structural change when it comes to revenue deficit grants. Could you explain that?
This is perhaps the single most significant structural reform in the entire report. The 16th Finance Commission has recommended the complete discontinuation of revenue deficit grants, or RDG.
But, sir, why remove RDG entirely? Weren't these grants a lifeline for states that couldn't meet their day-to-day expenses? Won't states like Kerala or Punjab suffer without the support?
The Commission's logic is all about fiscal discipline and the economic concept of moral hazard. Revenue deficit grants were, in essence, gap-filling funds. If a state spent more than it earned, the Finance Commission would just fill the gap. Dr. Panagaria's argument is that this creates a disincentive for states to be fiscally responsible. I mean, if you know someone else will pay your credit card bill every month, why would you stop spending? By removing RDG, states are now forced to find ways to generate their own revenue. It's a push towards self-sufficiency.
That's a tough pill to swallow, but I suppose it's a necessary one. So if the money isn't going to RDG, where is it going? I noticed a huge allocation for local bodies.
Correct. The focus has really shifted to the grassroots. There's an allocation of 8 lakh crore for local bodies. That's about 4.4 lakh crore for rural panchayats and 3.6 lakh for urban municipalities. But here's the catch, and this is crucial for the exam. The structure of these grants. They're split into basic grants, 80%, and performance grants, 20%.
Okay, so what determines if a local body gets that extra 20% performance grant?
It's all based on reforms, specifically 2 things: the timely constitution of state finance commissions and the proper transparent auditing of accounts. So if a state government delays its SFC reports, which they often do, or if a panchayat doesn't maintain clean books, they lose out on that 20%. It's a clever way to force state governments to empower local bodies.
And what about the basic grant, the 80%? Is that completely unconditional?
No, not entirely. Within that basic grant, there's another split. 50% is untied, which means it can be used for salaries, admin costs, whatever is needed. But the other 50% is tied to critical national priorities, specifically water, sanitation, and solid waste management.
So the message is pretty clear. Clean up your villages and cities, or you don't get all the money.
Exactly. And speaking of cities, the report has a special focus on urbanization that goes beyond just municipal grants. This is key for GS Paper 1 and 3.
Yes, I saw that. They recognize that India's future is urban. They've introduced special grants for the incubation of new cities.
It's a fascinating and forward-looking addition. This is aimed at peri-urban areas, those regions right on the outskirts of big cities like Delhi or Bangalore. These areas are often neglected. They're not quite rural, but they don't have city infrastructure yet. The FOSC is providing seed money to plan these areas before they become chaotic. There's also specific funding for wastewater management in mid-sized cities, a recognition that these are our future growth hubs.
Another critical area is disaster management. With climate change becoming more and more of a reality, how did the FOC handle that?
They've set aside roughly 2.4 lakh crore for disaster management. And the real shift here is in the philosophy. The focus is now heavily on mitigation, on preventing the disaster in the first place, rather than just on response and relief after it's already happened. It's all about building resilience.
Okay, let's move to the section on fiscal discipline. The syllabus has fiscal responsibility as an explicit topic. What are the new targets from the Commission?
Well, they've set a very clear glide path. For the center, the fiscal deficit target is 3.5% of GDP by 2030-31. For the states, the target is 3% of GSDP.
Those numbers seem fairly standard, but the Commission apparently came down very hard on off-budget liabilities. For a student writing a mains answer, how should we define that term?
That's an excellent question. Off-budget liabilities or off-budget borrowings. It's when a state gets its agencies or PSUs to take loans to fund government schemes. The government guarantees the loan and pays it back, but the debt doesn't show up on the state's main budget records.
Could you give an example?
Sure. Imagine a state wants to provide free electricity, but its budget is already stretched. So it asks its state power corporation to take a huge loan from a bank. The loan is in the PSU's name, but the government is paying the EMI. So the state's official fiscal deficit looks artificially low. It's a way of hiding debt. The 16th FC has taken a very strict stance on this. It must be completely eliminated. Total transparency. If you're borrowing, it has to be on the books.
So complete transparency is the mandate. I also saw a recommendation about the Powell sector. The DISCOMs have always been a financial black hole for states.
Indeed. The Commission had explicitly recommended the privatization of DISCOMs and the closure of chronically loss-making state PSUs, specifically any PSU that has been in loss for 3 out of the last 4 years. And this ties back to removing revenue deficit grants. If states stop losing money through their discoms, they won't need those deficit grants in the first place. It's a holistic approach.
So there was one constitutional detail you mentioned earlier about the state finance commissions.
Yes, a very important one. The FSC has suggested a constitutional amendment. See, right now, central funds for local bodies often get stuck because states don't submit their SFC reports on time. The Central FC is supposed to look at these reports. But what if they don't exist? The whole process just stalls.
So what's the proposed solution?
The amendment would allow the Central Finance Commission to bypass this requirement if states delay. It could then recommend grants directly to local bodies based on its own assessment. This would ensure funds flow right down to the panchayat level without being held hostage by state-level delays.
That would be a huge boost for the third tier of government. Sir, to wrap this up, let's try to summarize the high-yield points for our students, a sort of mental checklist for prelims and mains.
Let's do it. For prelims, you absolutely must know 1. The vertical split stays at 41%, and remember this excludes cessus and surcharges. 2. The horizontal formula, you have to memorize that table. Income distance, 42.5%, population 2011, 17.5%, demographic performance, 10%, area, 10%, forest, 10%, and the new guy, contribution to GDP, 10%. And 3. Grants. Know that revenue deficit grants are gone, and know the 50-50 split for tied and untied local grants.
And for mains, GS2 and GS3.
For mains, you need to think in themes. 1. Cooperative versus competitive federalism. This new formula balances need with efficiency. It's encouraging states to compete on economic performance. 2. Urbanization. You should mention the specific focus on waste management and peri-urban areas. Use the phrase incubation of new cities. And 3. Fiscal prudence. The move away from RDGs and the crackdown on off-budget borrowings, it all signals a shift towards hard budget constraints. The era of easy gap filling is over.
That gives us a really solid framework. It seems the 16th FC is really trying to push India from a purely welfare-dependent federalism towards a more performance-based federalism.
That is the perfect way to conclude. It balances equity helping the poor states with efficiency rewarding the contributors. This report is going to dictate the financial architecture of our country until 2031. It's so much more than numbers. It's the blueprint for India's next phase of growth.
Thank you, sir. That really clears up the confusion around the formula changes and the logic behind them. The why is definitely much clearer now.
I really hope this deep dive has provided complete conceptual clarity for your exams. Remember, in the exam hall, precision is everything. Use the correct terms. Vertical devolution, income distance, off-budget liabilities. For more